Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have a very special guest in Mr. Scott Modelski, Managing Director at Black Bear Capital Partners. Before we dive in, I want to cut a deal with you. If this episode adds more than $100 of value, would you please take 30 seconds to leave a review? This helps us get more listeners, and it lights me up when I see a new review. So thank you for taking the time to do that. All right, let's dive in. Scott Modelski is a loan broker with over 15 years of commercial real estate experience, working with institutional and entrepreneurial sponsors across a variety of asset classes. Scott started out his career as a member of the Wells Fargo Bank Commercial Real Estate Group, where he worked on over $1 billion in transactions. He helps with the sourcing and execution of structured debt and equity transactions. Welcome to the show, Scott.
Absolutely. Hey, Andrew, how are you? Thanks for the invite. Excited to be here.
Yeah. Would you mind starting out by sharing your story with our listeners and how you ultimately got into sourcing debt for, manufactured housing communities for sponsors like myself?
Yeah, sure. So, I guess I had a little bit more of a typical path in the real estate space. So I actually went to school for real estate at Wisconsin, which kind of fell into it. Went to Wisconsin really looking to do finance. Double majored in finance, took a couple of real estate classes, found out their program was one of the top programs in the country and really enjoyed it. And ended up getting an internship at Wells out of school and then joined their team on the construction lending side back in '07. So things were still good in '07, quickly found myself doing more special assets work in '08 and was there in special assets for quite some time from really '08 to 2012, was doing loan workouts and own real estate and things like that. And then when things kind of healed, got back on the origination side of the bank, did that for a few years. And then back in 18, left to do something a little bit more entrepreneurial, which was, loan brokerage. The bank was great, learned a ton, got a lot of exposure to all different asset classes and lots of different things that, probably wouldn't be available to me on my own, but wanted to do something entrepreneurial and left in 18 to join a boutique brokerage shop in Chicago called Alpha Capital. Was there for a couple of years and then joined Black Bear in 2020. And then really the story about how I got into the MH space is through Mike McClellan, who introduced me to you. So Mike's a good friend of mine. He was a coworker of mine over at Morgan Stanley, and he got into the space. And you guys ended up partnering on a deal, and he approached me once those deals were ready for refinance and helped you guys execute on a CMBS deal back, I guess, what was it? Was that 20 or 21? A few years back.
I feel like that was before COVID. So I want to say 2019.
It would have been right after, I think.
Would have been right after? Okay.
Yeah, because I was at Black Bear and I joined in 2020. So I think it must have been in 2020 that we did that.
2020. Okay. Yeah.
And then that's how I ended up kind of finding my way into the space and kind of working with you guys. And then from you, we're able to meet some of the colleagues that you've introduced me to, and then some other folks through MHI and other means. So kind of dove into the space. It's interesting. I mean, especially right now, it's one of the most active spaces in CRE right now. I mean, I think a lot of other asset classes, particularly multifamily, definitely office, have really hit the skids. But mobile homes, RV parks, it seems like things are still full speed ahead. I think the deals are structured a little bit differently, and a lot of the clients are buying with seller finance and a little bit more creative financing on the front end. But there's still an active market for perm finance, either through the agencies or CMBS, and we're still seeing a lot of that business come through.
That's interesting, though. So back to your story, if you don't mind, 2008 to 2010, like the Great Recession workouts. What did you learn during that time that maybe you like carry with you, like working on some of these CRE loans that obviously were distressed? And, I guess, what don't we know about that time that we should, right? About banks and what is a workout and And what were the type of deals you were cutting, that are possible that maybe we don't know about?
Yeah, it was really interesting because I was at the very beginning of my career. So I guess I had a little bit of a different perspective because like when I started, I really only caught like the tail end of like a quote unquote good market and really kind of came in fresh and just kind of saw all the things that like could go wrong. I guess to your question, like to me, it just was, and it's always been in the back of my mind since then in the business is like things can turn, right? Like everything from 2001 to 2008 was kind of like blowing and going. Values were coming up, and then all of a sudden the music stopped, right? And you look at some of these deals that were made, and sometimes it was like a head scratcher because I was kind of coming in at the end when things already were sideways. But I think the mentality was the music's never going to stop. We're just going to keep like the values just go up.
And I think we know that, but like you were working out loans with borrowers that were in default, right?
Right, correct, yeah.
So like, tell us about that because, I guess at Wells Fargo, they probably don't want these assets, right? They're not like trying to take the assets back. They're trying to just like restructure the debt. Is that kind of what you were doing most of the time?
Yeah.
Or what is that?
I'd say there's probably three ideal solution sets for the lender. Number one is a restructure, right? Like you just said, you hit the nail on the head. The bank really isn't in the business of taking title to commercial real estate. They want to lend money and they want to get repaid. So in an ideal scenario, and most of the deals we were working on had some level of recourse. So we use that as effectively a bargaining chip. Almost never did we pursue someone for their full guarantee. And that's maybe just a Wells Fargo thing. But in that era, we were really using that as like a bargaining chip to say, hey, Mr. Borrower, you owe us X. We understand that, we are underwater. Maybe you're 120% LTV. True us up to like 90 or 95%. And in exchange, we'll give you another year, 18 months, 24 months, and then we'll reevaluate then and just try to like keep, basically if the borrower was playing nice in the sandbox with us, Wells' mentality at that time was, let's continue to work with the borrower. Let's find a solution set. As long as they can kind of, work with us and help bring some additional capital to the table, let's try to find a solution. There were definitely situations though where we took other actions, right? Like there were times where either the borrower just like threw their hands up and said, I don't have any more capacity to put any more money in, or like, I don't want to. And in those situations, like there was a couple of different remedies. Probably the thing that we did the most was note sales. So, we would go out and sell our debt, our position through one of the major brokerage houses out in the market. And primarily the buyers were looking to get to title, right? So, they would look at what's the underlying value of the collateral, and then probably take a little bit of a discount because they were buying the debt because they needed to go through the foreclosure process. There was a little bit more of a legal hoop to jump through to get to title. We would also take title. We would, foreclose on certain assets where we thought there was more value in the future than there would be today if we went through, say, a note sale. And Wells was a little unique. The team that I worked for was primarily working through the debt from the Wachovia side. It was actually kind of separate, like two different sides of the house right after that merger. I mean, that's kind of ancient history now, but Wells bought Wachovia Bank, which was like a large East Coast bank at the time. And Wachovia, right before they went under, actually hired a developer to run their own real estate team. So they had a little bit of a different perspective on taking title than a lot of our peers. So we had the folks, and I ended up working on that team for a few years, where we felt like we could manage and hold real estate and kind of maximize the value and then go through a disposition a couple of years later if the circumstances were right. So, in certain deals where, the borrower just kind of capitulated and didn't really have the wherewithal or, the ability to kind of continue on, there were instances where we took title and worked through the deals. And those ranged all over. I mean, there was a lot of home builder deals. So we were doing a lot of, we owned a lot of golf courses on the East Coast, and we're selling lots to home builders. And we had some unique structures where, they might have no idea what these lots are worth. So we were like, all right, well, we'll sell you the lot for $1. And then we want to get trued up 20% of the value of the house once you sell it. So, there was some creative stuff. We did that. We took a lot of retail where we ended up like leasing it up over time. The multifamily back then was selling. So we never really took title of that because there was such high demand for the notes. But some of the other more asset classes, like a home build, like a single family lot development or a retail center or office, a lot of times those were the deals that we took back because we just thought the market was too weak to sell into. And it's interesting, I still have a lot of colleagues in that arena today, and it's been slow. Like the banks right now are not really taking a lot of action. I have a pretty interesting seat because obviously I sat in that chair at Wells in the past. So I know a lot of folks on that team. And then we know debt funds all across the spectrum. So I talk to those guys all the time. And it's interesting that what you hear, the banks really aren't. Back in 08, 09, the FDIC, the regulators came in and basically told the banks, clean up your balance sheets, start moving this. I think the exact opposite has been delivered to them in this go around. It's more, let's play nice in the sandbox with your borrowers, like try to find a solution, don't get too aggressive. And that's kind of where the banks are right now, unless there's certain deals. I mean, a lot of office projects and major CBDs across the country, there's just nothing left. But even still, you're seeing more like discounted payoffs where the borrowers are just selling into the market today, and the banks are just taking a bit of a haircut on their note just to move it. Or they might actually be doing some seller finance too on their own, just to kind of make sure that the deal gets consummated. But you're not really seeing like wholesale action taken against borrowers. I think the banks are really trying to help their borrowers through this time, which is good, right? I think a lot of this is outside their control with interest rates rising, and I think the regulators understand that. I think there's also a sense that maybe this is a point in time. There's definitely a lot of rhetoric out there around like rates coming back down, and maybe I don't think that'll solve everyone's problem, but it solves a good amount of people's problems if rates come back to a more normalized environment. Yeah. The other thing, like the debt funds too, they don't really want to take title of this stuff too. You talk to them and they're like, well, if we have distressed deals in our balance sheet, it hurts our funding from our equity investors and our bank lines. So they're trying to do everything too to kind of help their borrowers get to, a better place without really kind of taking aggressive action. So, it's interesting. This every cycle is a little bit different. This cycle is definitely different from that regard. We're like 08, 09, it was kind of clear the decks. And this one is, I think that's why we're in this slow slog where activity is down 80% year over year. And everyone feels like there's just no deals out there because there really aren't. The lenders aren't really forcing the issue. And, it's hard if you've got a deal that's a little bit upside down to really do anything right now. You're better off just kind of working out with your existing lender and hoping for a better day.
Yeah, no, that's really good feedback there. And thank you for sharing that. So
yeah,
just to recap, the workouts and kind of your time during the Great Recession, you said those three options was at Wells was, number one, restructure the loan. Hey, Mr. Sponsor, come to the table and, your loan to value is 120%, bring some capital to the table and get us down to 90 to 95%, and we'll extend your loan, something like that. And then the other one would be the sale of the loan, right? Like option two would be, okay, we would note sale, would sell the non-performing note to another bank that would come in and try to, either restructure again or do something like that. Then number three would be take title.
Necessarily wouldn't be to another bank. It'd really be to an operator. A lot of the people that were buying the notes were, other real estate investors that were looking to get to the title, the fee simple title. Basically it was just a quicker way for the bank to sell the real estate without having to go through the foreclosure process and let somebody else go through it. I don't think all of those deals ended up getting foreclosed. I think a lot of times, the borrower ended up finding somebody else to like refi them out, or they were able to kind of keep the note current. But a lot of those note sales, the goal of the purchaser was to go ahead and try to get to the underlying real estate.
Gotcha. That's good to know. Well, right now, as we record this in April 2024, it's an interesting time in CRE. I mean, if you Google commercial real estate, you see all these articles talking about how it's underwater. There's all these properties that are going down. But really, from my research, it's really just a small cohort, like you mentioned, some office and then, some multifamily that had some, I would say creative debt structures with very high loan to values and some variable rates that are getting into trouble. But what blood are you seeing in the streets as we record this?
Yeah, not as much as you'd think. I think, like I mentioned, it's really all the distress that I've seen right now is in the office arena. And a lot of those deals, I think they're really hard to figure out because we still just, you guys all know this, haven't seen folks come back to work like they were pre-recession. So, or pre-COVID, I should say. Mm-hmm. So, they're just very difficult to value right now. And I think that's where a lot of the concern is. It's just the uncertainty. Maybe that market bounces back. I'm not one of those people that thinks there's the death of the office. I really think at the end of the day, like, we're social animals. Like, the companies that have people back in the office, I think, are going to do better than the folks that are kind of disparate around, at home, working at home. But that's just my opinion. But for the next foreseeable future, I think there's going to be a lot of issues with the office space just because there's just too much uncertainty. And like you said, on the multi side, it's really groups that are over leveraged. I think the properties are performing. Rents are still high. The fundamentals are good. One place where people are getting a little bit of trouble or some of their expenses are increasing, especially in insurance. If you're in the Southeast kind of Gulf Coast market, particularly your insurance costs have gone up a lot. But all around the country, people are experiencing increases in their expenses, primarily insurance. But, if you are moderately leveraged, that's still, hurting your bottom line, but it's not like tipping you over the edge. I think it's really just the folks that took too much debt, kind of overpaid during, the boom time, 21, 22. But at the end of the day, once properties are fine, their capital just needs to be restructured.
Yep. No, that's good feedback there. Now let's talk about like mobile home parks. So what have you seen there? Have you seen some operators come to you and say, hey, we need to do a restructure of our capital. We have some, some issues here, or, we need to, do something creative. Have you ever seen some distress or operators that have interesting, scenarios there with their debt needs?
I really haven't seen the distress kind of really come through on the MH front yet. I think, the last few years have been such a, kind of boom for that market, right? Rents have gone up significantly. There's a lot of new entrants into the market too that have brought in a lot of fresh capital into these projects. I really haven't seen anyone come to me on the mobile home front and have that scenario. I have heard kind of through the grapevine that there are selectively some deals that are troubled. I know a few clients of mine have been bidding on some deals where, that's the situation, but it's not anything that you kind of paint the entire market with like a broad brush and say, the mobile home space is experiencing some distress. And there's always some level of distress in the marketplace, even in a really strong up market. So, but I don't really think there's a significant level of distress in the MH space right now. At least from what I've seen in my share.
No, I don't either. I think there's, some, like you said, there's some stuff going on where there was some interesting, financing done from what I've heard from some other operators, that they, similar to multifamily, they were kind of, needing to buy rate caps and things like that. But I think the assets are performing. I think that's one thing that we can see. I was reading the Marcus and Millichap. They have like a manufactured housing review that they send out, and the asset class is performing really well. So for you, Scott, as a loan broker, sourcing debt for mobile home park operators, what should our listeners know and myself know that we don't know about that job, about that task?
I think what you should know that you don't know, I think the good thing about, using a broker is that we can really cover the entire market, right? I know everyone has their lender relationships, which they should, right? You should always have your kind of go-to relationship lenders. Having been in a relationship lender, I totally understand the benefit of that for both sides of the party. But there's also a lot of, especially in a market like this, where there's capital disruptions, I think what visibility we see in the marketplace is there's this whole subsector of, non-bank lenders, the debt funds of the world that can have a very different perspective on the market. And so with the banks pulling back, we've really seen those non-bank lenders step into the void and provide capital for a lot of projects that are great projects, but the banks just aren't really there for them right now.
And these are,
So
I'm assuming these are like heavy, like either development or heavy value add projects, and operators are using these debt funds as like a bridge facility to, to get the deal done, to stabilization. Is that right?
Yeah, thanks for asking that, because I should clarify. Yeah, so the debt funds are primarily shorter term loan vehicles, 2 to 3 years. And yeah, they're primarily beneficial for when you're doing a value add, right? Because they can provide some, pretty aggressive capital on the front end for the acquisition. And then oftentimes they can bring in a facility for 100% of your CapEx. MH is a little bit different because the homes themselves are chattel and not real property. But there are a few lenders out there that can provide a line for the homes and the installation and that type of CapEx. But, primarily what they'd love to finance is, improvements
The real
to the
estate.
infrastructure,
Yeah.
the roads, the water, the sewer, any, water treatment plants, the quote unquote real estate versus the chattel. And so, for groups that are maybe a little bit less well capitalized on the equity front, it's a really great opportunity to get into, one of these loans, because they can kind of help bridge that gap on the equity front and kind of provide a higher leverage transaction, especially when there's a lot of upside in the deal.
Yeah. What's a typical, what are the typical terms for, a deal like this? If on a mobile home park, if you had a value add deal and, are they willing to take like a second position, behind like a primary lender? Is that possible or?
Yeah, I mean, we definitely have, relationships with mezzanine and preferred equity lenders. The one thing about the mobile home space is that the property values are a little bit lower than in some of the other asset classes. So for most of those pref lenders, mezz and pref lenders, they want to see, $3 to $5 million plus of, a check size. So for mobile homes, there's, typically the deal sizes aren't large enough to really make sense on mezz or pref. Typically, you'll get a bridge lender that's kind of like a stretch senior, if you will. So it's one facility, and they're basically like acting as both the senior and the mezz and the pref, and kind of wrapping it all into one and kind of pricing it as one. So, historically, you could get up to 80, 85% loan to cost. In today's market, what they're doing is they're trying to look at, okay, once you're done with your value add, what type of exit is there from, either an agency or CMBS loan? And what's our payoff? And they're kind of backing into their initial leverage based on that. So where rates are today, they're really kind of constraining your back end takeout. So realistically, I'd say like the top end is really probably like 75% loan to cost in today's market, plus, that CapEx dollars that you'll spend primarily on infrastructure. And, today pricing is, the benchmark.
And we don't need to go down like a whole rabbit hole, because it kind of seems like it's not applicable as much to MH as it is to other asset classes. But let's circle back, because I know you've worked with several different mobile home park operators, to source debt. What have you learned about mobile home park sponsors? And, maybe you can touch on like their risk appetite, like their different deal, structures and strategies. And I think that would be important to talk about. Something cool to talk about.
Yeah, I think the one interesting thing about the MH space is you have this group of younger investors, 30, I'd say like early to late 30s. There's this larger group of individuals who've kind of like taken this on and really stepped into this asset class. Because I think previously, it was kind of like a mom and pop. People have owned these properties for 30, 40 plus years. There really wasn't a lot of activity in the MH space. Now it seems like this is like the new asset class that people are really excited about. Where, compared to the other asset classes, I think there are a lot more established groups, right? Like guys who've been in the game for a long time. There's definitely your upstarts groups in the multifamily space too. But I feel like the groups that are focused on MH tend to be like very much go-getters. Like they're out there trying to really make their mark in a really quick fashion. And I think, I don't necessarily think they're more aggressive than folks in other asset classes. I think like everybody who's in the real estate market kind of is cut from the same cloth. They're entrepreneurial. They're definitely like high risk tolerant. But I think the folks in the mobile home space maybe look at things a little bit differently. I think there's so much historically, the asset class hasn't really been viewed that favorably. And so like you're kind of fighting an uphill battle sometimes with some lenders around like the perspective of the asset class. And so I think there's just a lot of optimism in the investor community in the MH space because they're looking at something that, historically hasn't really been that appealing and digging into it and really finding like kind of like a needle in a haystack.
And with the operators that you've dealt with, like what makes one different from the next? Or do they all do they all fit into this mold? Or would you say that they have unique kind of business models and strategies and if as an LP, right, if you're looking to invest with an operator, I guess what should they look at from like not only the financing they're taking and how they're structuring that, their capital stack, but also like just them and their strategy and business model?
Yeah, that's a great question. So I'll take the first part of that question first. I think there's definitely a wide range of both personalities and market outlooks and the way people put together deals. So I don't think it's a, kind of uniform
one size fits all.
Yeah, perspective on the market. I really think like everybody likes a little bit of a different geography. Everybody likes a little bit of a different deal. Like some guys like the really hairy deals where they can go in and add a lot of value. Some guys want more established, more, closer to stabilized transactions. Some people are looking at on-market deals. Some people are only looking at off-market deals. I think there's a huge range of perspective on the market and what people are trying to do. And then to your question about LPs, I mean, to me, I really think it's track record, right? I think if you're looking at different LPs, I think you really want to understand like their experience in this space. And, I think like, for instance, a group like you guys have been, active in the space for a number of years, have a real strong track record that you can point to around being able to execute in the space. Because I think, MH more than anything, the operator can drive a ton of value, right? And if you don't really have the expertise on how to source and bring in homes, how to structure like the sale of homes, like how to vet the tenant roster, how to manage the assets, I think you can kind of miss a lot of the opportunity. Or, you don't necessarily want to figure it out along with your GP, right? I think that's
pay for an education
exactly,
of your GP.
Exactly, right? Like for me, if I were an LP or as an LP, like I definitely want to make sure that the mousetrap's already been built by my GP, right? Like I don't need to worry about like, can they actually pull this off? I want to make sure that my group is somebody that I know has expertise in the space and has a track record. Now, not every deal is going to be a home run, but you want to at least know that the group that you're working with, if they do run into problems, they know how to solve them.
That's the key. Yeah. Like what mistakes have they made and learned from, I think is important. But yeah, thank you for the compliment, Scott. I appreciate that. But yeah, I mean, like earlier today, I was on a due diligence review meeting for our new deal that we're working on. And it's, we're going granular. We're going into so many other avenues that when I bought my first mobile home park, we didn't even scratch the surface of how deep we're going now, with how granular we're getting to make sure we know what we're buying with the utility infrastructure and our inspections that we're paying for and all of that. So there definitely is something, to be said about track record for sure. Go ahead.
From my perspective, I feel like of all the asset classes, mobile homes are the most nuanced, right? Like there's so many more nuances to investing in mobile homes versus other assets that if you don't have that track record, you can really find yourself in a messy situation. So I didn't mean to cut you off, but that's something I really wanted to make sure of because it's a different animal than your other traditional asset classes that people invest in.
Definitely. No, and I wanted to talk about this because I know we've worked on some hairy deals together. And I think, with mobile home parks, there's the opportunity to add value and a lot of value really fast. So maybe you can talk about that, just because I think as LPs looking in, they may not know all the nuances of going from, say, a regional lender to, an agency lender and what's all involved in that. We've had, oil and gas leases that we've come across. We've had, underground gas lines that were under homes. We've had other things that have, what was the one in Michigan that we just got held up with?
Oh, the licensing. I think
It was
the
licensed for
licensing.
a less number of lots than we had.
Oh, it was because they were the RV component wasn't licensed as an MH, but it was like grandfathered in, and it just wasn't papered right by the prior owner.
There's a lot of just nuances to it. So I guess, on a good operator that you're looking at the refinance value, what do LPs need to know about how they've added value and how the income has seasoned and things like that, if you don't mind touching on that.
Yeah. And to your point, I, being relatively newer to the space, probably working on it for like last 3 or 4 years over, versus like about 15 years of my career, it was really eye-opening to see how quickly you can add value, right? So I think the interesting opportunity for mobile homes is you've got a lot of parks that have been sitting that are 60%, 70% occupied. The cash flow well, the existing ownership isn't really concerned about it. They may not even have any debt. And so, for them, this is stabilized. But if you can come in with a fresh set of eyes and fresh capital and bring the community up to date, bring in new homes, you can add tremendous value by increasing that occupancy from 60 or 70% up to, call it 90, 95, or even 100, right? And you can do that in a significant amount of time. Now, take multifamily. Like, how many multifamily deals have been sitting at 60% occupied for the last 10, 20 years? It just doesn't exist.
Doesn't exist. Yeah.
It doesn't exist. Maybe in retail you can do that, but you're taking on a lot of risk. Like, typically, like those retail projects that are sitting at that level of occupancy, there's a reason for it. I mean, for mobile homes, the reason is just more or less momentum. It's been fine. I don't really need to deal with it. Maybe my dad bought this and I inherited it, and I just think it's fine to just clip my coupon because I don't have to worry about it. So the opportunity set to add significant value in a short amount of time is really unprecedented. Like, I don't see that in other asset classes. That's really, the big driver in value. And so, for me, when I started working with you, I think the one thing that really was shocking was just, we were within 18, 24, 36 months doing a refinance off of your existing loan, and not only paying off the existing loan, but paying back all of your equity plus some. I mean, we were doing 140% cash out over and above the original investment. Like, that I just don't see. Like, that takes you 10, 15, 20 years in multifamily, right? And it's from like compounding rent growth. You just don't see those kind of cash outs. So, like, the one thing that is great, the other thing that's a little bit challenging about that is, like, sometimes the value add is so significant, we really have to push on the lenders to get them to accept the cash out, because they get a little bit concerned around how much money they're cashing out in such a short amount of time. But that's a good problem to have, right? Yeah. I mean, that just means you've got significant cash flow coming out. But, luckily, we've found some great lenders to work with that have been accommodating to us and helping kind of make that happen. But, you just don't see that in other asset classes unless there's some like unique opportunity where you hit like a home run. But you can't underwrite that way. In the mobile home space, like, from what I've seen you guys do, and I think a lot of it has to do, and I'll give you some kudos on your ability to find these opportunities, because they're not just in your face. Like, I know you and your team are sifting through tons and tons of opportunities to find the right ones. And, they've worked out incredibly well for you and your investors.
Well, thank you. Yeah. And thank you for your help. Sourcing that agency debt has been, huge for us. Maybe you can touch on that briefly and talk about what the agencies are doing in the MHP space, kind of what their terms are looking like right now, spreads and so forth, and what's their appetite.
Yeah. And so for folks who don't know, the agencies are Fannie Mae, Freddie Mac. They're the two, pseudo government agencies that, really are there to provide capital for housing. So, historically, they've provided a lot of capital to the multifamily space. Over the last 10 years or so, they've really taken a deeper look at the mobile home communities. And so, that's opened up a lot of opportunity to get non-recourse financing on, a 5 or a 10-year term, and really pull out a lot of equity on some of these value add deals. So where they are today, I think historically all the deals have been 10-year deals. We're seeing, where, yields are on, the 5-year treasury and 10-year treasury. Most investors want 5-year money. And I think, at the beginning of this cycle when rates really rose, the 5-year was pricing much wider than the 10 just because there wasn't a lot of bond buyer interest in that. But that's changed. So, 5-year pricing really isn't that much different than the 10-year right now. And so we're seeing a lot of interest in the 5-year pricing. And right now, just for an example, it's somewhere like mid to high 6%, up to 7%. It's your all-in fixed rate. So the rates are fixed for either 5 or 10 years. And typically we've been able to get interest only for the term. And that's really at 65% loan to value and below. Above that, they're going to want to see some level of amortization, typically 30 years. But, the terms are really predicated on the leverage you take. So, even though we've been doing some significant cash outs together, the interesting thing is there's still significant value left in these properties. So, it helps us, with the Keel team get, interest only for 5 or 10 years and, really drive, additional cash flow from that perspective as well. So, the agencies are active, but their job is to kind of provide capital for housing across the country, particularly, what they call workforce housing, which is, lower income type communities that are, either, not necessarily rent controlled. Some of them are, but a lot of them are just what they call naturally affordable. And mobile homes definitely falls into that category.
Definitely. And I think that's important to note is like it's a win-win. What I've noticed from the agency lenders is they're really working hard to provide the best in asset class financing terms, but they come with some strings attached, right? Like the properties have to meet a certain level of quality. They can't, they're going to have an engineer come through and check the whole property and tell you trees need to be trimmed and that, streets need to be repaired and that, sidewalks need to be re-leveled if there's roots, popping them up. So there's some additional repairs that are going to be needed and, hitches need to be removed and skirting needs to be in place. Like it has to be, no deferred maintenance basically, to get one of these loans, which is a win for the community, right? For the tenants that live there because the property is going to be maintained better. And then it's a win for the investors, right? Because they get, they're getting great terms, the best in asset class terms, for these properties. And then they also recently came out with the tenant protections, that if you get an agency loan, maybe you could touch on that briefly with just some of those requirements of what the agency lenders are looking for, by an operator getting one of these loans. They're asking that you give certain tenant rights, that they need to be aware of.
Yeah, and that's a good point. I'm glad you brought that up. Yeah, so really the reason that the agencies are able to provide kind of, best in market financing terms is because they are definitely there to make sure that these properties are up to snuff with what they expect for the tenant roster, right? They're not looking to finance projects where, the landlord isn't taking care of the asset. You definitely need to be on top of your property and have it in, tip-top shape in order to get qualified for agency finance. So I'm glad you brought that up. And typically, just to kind of give clarification, they'll have an inspector come out and determine, immediate repairs, long-term repairs. And you're going to have to, reserve capital from the loan over time to kind of make those repairs. And they're sending somebody out every year to make sure that you're agreeing to, what they originally said on the front end. And then on your tenant site protection, that's something that the agencies put in about a year and a half ago. And it's kind of another layer of protection for the tenants in these mobile home communities. I think,
it's not unreasonable, right? It's not like, you can't raise rents on them or something like that. It's more, I don't know. I just remember thinking like it's more like providing them, consistent rules and regulations and an annual lease and things like that, right?
Yeah, it's like really setting a framework. And I can't recall all the guidelines, but the one thing that's the main driver is that they want to have an established rules and regulations for the park that everyone from a tenancy perspective kind of agrees to on the front end. And I think that's for their benefit and also for their neighbors' benefit, right? I think if everyone's got the same set of rules, they understand what is expected for them to live in this kind of quality community. And then there's simple things like the initial lease needs to be annual, and then, it needs to be able to roll over in a month to month. And there's some restrictions around, like you said, like how much and how quickly you can raise rents and the notification period that's needed in order to raise rent. So they're not really like putting a limit on it. It's more or less just like putting a framework around like
The
how
notice
you need
time
to
period. I think that
notify.
was a big one. Yeah. Like you need to
The
give them at
notice
least
period.
60 days before a rent increase, where maybe some states only require 30 days. So yeah, I think it's there's some benefit to it if we're looking at it like, hey, we're providing housing. Like this is not, this is not strictly, commercial retail type of tenants. This is housing. Right. This is a fragile tenant base in some aspects. So
yeah, absolutely. And they want to make sure that those folks are protected, which I think, from your shoes, my shoes, everyone's shoes, everyone wants to do that. Right. Yeah. And I think it's good to have kind of like a base framework to work off of. And I know, when they were originally putting that together, I know a lot of like the larger, more institutional type ownership groups were in those meetings and helping kind of craft that language. So I think the good thing is they were open to and really listened to the investor community on how best to put this together.
Totally. What should a passive investor, limited partner know about the 10-year treasury, and like what influences the 10-year treasury?
Yeah, that's a great question. So, really everything in finance, more or less, like kind of revolves around the 10-year treasury. It's a lot of what these longer term loans, the 10-year loans are priced off of. So to make it very simple, the benchmark rate, if you will, is the 10-year treasury. So typically when you're pricing a loan, you add a spread. It's kind of like for the risk premium. And you got to look at the 10-year, like if you're taking no risk, this is the return you're going to get. So if you're going to buy these loans, you want to have a spread over and above the 10-year because there's some risk involved, right? Like there's another party, not just the U.S. government, that needs to perform to make these loan payments. So typically that's why they have a spread, and the spread ranges depending on the asset class and where we are in the market. Somewhere between 200 to 300 basis points, or in layman's term, 2 to 3% over what the 10-year treasury is. And right now, the 10-year moved up a bit. It's around like 4.3%. So, to add that 2 to 3%, you're talking about 6.3 to 7.3 is where, your loans are typically structured or priced for a 10-year term, depending on a variety of factors, including like the strength of the sponsorship and the strength of the asset. So, that's been moving around a ton. I think last year it got up to 5%. Before that, it got down to a low, like 3.9%. So there's a lot of volatility in the market. And, it's an interesting time. Typically, it's a little bit more slow and steady movements in the 10-year, but we've seen some wild swings in the last year and a half, just as people are trying to digest, is the Fed cutting rates, is the Fed increasing rates, are they keeping steady? There's just a lot of unknowns out there, which is causing the market to kind of jump around a bit.
Yeah, no, that makes sense. And it seems that most investors are expecting the Fed to, start cutting rates, right, in June of 2024, which is just a few months away. What advice do you have for, maybe sponsors or investors or owners that maybe are looking to sell out there, or, maybe looking to refinance? Would now be a good time, or should they wait, once those rates potentially go down in 6 to 12 months if they can?
Yeah, it's interesting because the rate decreases or increases are really on the short end. So the Fed kind of controls that overnight lending rate, which is the shortest term, and that's what the Fed lends to banks. So that doesn't always necessarily translate to the longer term notes, which are more traded on the marketplace and open to more supply and demand type movement. So there's actually this article in the Wall Street Journal the other week that was saying like, hey, even if they decrease rates 75 to 100 basis points like expected, the expectation is like the long-term 10-year treasury stays pretty constant. And right now, it's already kind of priced that in, because if you look at the short-term rates, the 1 month treasury is 5.5%. And the 10-year right now is 4.3%. So there's already kind of this expectation that's built into that pricing of the rates coming down. Because really, the simplest way to look at it is the 10 years kind of priced to based on the forecast of what all the short-term rates are going to be expected over the next 10 years. So it's kind of already priced in. So I know I've spoken to a lot of folks that have said like, hey, I want to wait because I think rates are coming down. And I think that's really mostly true for short term, right? If you're looking for short term bank or bridge loans or floating, that will come down. But I think like the 5 and the 10 year is kind of already priced in. Wall Street's smart. They're not going to get caught off guard by this. The only time they will is if there's something unexpected, right? Inflation, where you might see if inflation really comes down and then like the next couple months, like the readings come down, you might see the 10 year really kind of react to that because that's unexpected. But right now, if everything stays status quo and the Fed really does start decreasing a quarter point in June, a quarter point in September, and then one in December, it's really already priced in on the longer end of the curve.
That's good to know. Scott, I would ask, like, what do you think the perfect mobile home park looks like from a debt perspective, right? If you want to get the best debt possible, what does that perfect mobile home park need to look like?
Yeah, I think you want to have a high quality park. And I'm not sure if folks are aware, but there's a kind of a star rating that the agencies, utilize to kind of rate their parks. 3-star is kind of the middle of the row. Everything's fine, but nothing's great. 4 stars better, 5 stars immaculate, right?
Mm-hmm.
So to get the best terms, obviously you'd want a 5-star park. You want to be as occupied as close to 100% as possible with a really stable tenancy, right? The longer that your rents have been in place at that level, the more security the more secure the lenders feel in you continuing to be able to collect those rents. And, I think the lower the leverage, the better pricing you're going to get. So there's some like jump ups, anything below 50% is the best pricing. 50 to 65 is like the next tier after that. And then anything 65 to 75 is the higher tier after that. And that's typically how the agencies price. So, in short, highest quality asset, highest occupancy with, long-term consistent paying tenants. The one thing they look at is your collections history. So you want to have, make sure that you don't have a lot of delinquent tenants. They're paying on time. Your collections are stable and a lower leverage deal. And that's how you'd get the best execution on an agency loan.
Nice. Any other tips on how like an operator or a sponsor can best prepare, for like a refinance to get the best terms possible? I mean, probably like getting your financials in order and making sure there's not like CapEx costs on your P&Ls and, just real quickly, because I know we're kind of running out.
Yeah. And I think that's what you just hit the nail on the head, right? I think a lot of times something that I do with my sponsors is make sure that the financials are quote unquote clean, right? I think there's a way to present financial statements to a lender that don't necessarily equate to like how you want to prepare them for your taxes or how you want to prepare them for maybe even your investors. You want to strip out all these like one-time CapEx expenses. For taxes, you want to keep them in, right? You want to keep your income low. For a lender, it's the opposite. You want to make sure that your income looks high and it looks steady. So we work through, going through the financials and saying like, oh, is this plumbing expense? Is that going to recur every month or is that just like a one-time? No, we need to do a one-time thing. So let's pull that out, right? Let's make sure that that's a CapEx item. Or like, hey, did you have to not plow, but like pave your streets every year? Or is it like once every 10 years? Oh, it's only once. Let's pull that expense out. So there's ways to kind of make the financials more presentable for a lender that are a bit unique. And that's where, a broker or an advisor like me can kind of come in and kind of help consult you on the best way. And, really, you don't even have to restate your statements. We just kind of respread them and kind of show all the expenses. We just show them below the NOI and show them as, more capital expenditures and not ongoing expenses.
Awesome. Scott, how can our listeners get a hold of you if they'd like to do so?
Yeah, sure. You can find my contact information on our website, which is bbdp-llc.com. And you can find my cell, my email. My cell 312-217-4511. And then the email is too long, so you guys can look it up, and I'm sure it'll be included with the podcast. But happy to help anybody who's looking at any potential acquisitions or refinance opportunities in the mobile home space. We do this all day long, and happy to meet new investors and see if we can kind of help them on their debt needs. Yeah,
and I think we've worked on over 30, $40 million?
It's 50. I just looked it up
50.
before the call. Yeah, it's just shy of 50, and I think it's like 15 deals or so over the last few years. So yeah, it's been a significant amount of transactions over the last few years. So it's always exciting to work with you guys and see, the execution and how much value you've created in such a short amount of time. It's always impressive. I always get a kick out of seeing how much value you've added over such a short period of time.
Well, thank you, Scott, and thanks for coming on the show to help educate our listeners.
Yeah, absolutely. Very excited to be a part of this, and thanks for including me.
That's it for today, folks. Here's a quick reminder for you to please leave a review if you got value out of this show. These mean the world to me, so thank you for taking time to do that. Thank you all so much for tuning in.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.